Says the odds of a recession are rising despite today's rally in the stock market. Joining us now is Citi Global Wealth's head of North America investments, Kristen Bitterly. Kristen, great to see you. Odds of recession being higher, I mean, seems like that's certainly coming out of both the data that we've seen, the market action, and I guess just the knowledge that, you know, what the Fed's already done is working its way through the system. What is the bottom line on what that should mean for an investor today?
I think what it means for an investor today is that we're going to see volatility over the next couple of months. So the market is going to debate whether or not whether this is a recessionary bear market or whether it's a non-recessionary bear market. We have the probability of a recession at about 40% going into next year. We wouldn't see that until next year just because the tightening that we're seeing from the Fed generally takes around 12 to 18 months to really show up in economic conditions. Our base case is actually to see some resiliency at about 45%, but that's going to require some very strong finesse, I think, from the Fed and some abatement of inflation over the next couple of months. So expect volatility.
And so it seems as if there would be almost two different playbooks if you were to say, we think the Fed's going to be successful, inflation's going to moderate, the Fed can back away, and maybe you can buy things that are more cyclical or vice versa, if in fact it's going to be more persistent. And it's a tricky one here because things that do well with inflation, in theory, would not be the things that would do well in the old days when you were expecting bad economic outcomes. So which way do we go, and what does it mean specifically?
I think you have to prepare for both, actually. You have to prepare for either this resilient scenario or the recessionary scenario, because effectively what we're looking at is the difference between where we're trading right now in equities versus where we could be if we tip over into a recession. You could see some downside off of the all-time highs of an additional 10% or even 15%. If we're not in that recessionary scenario, a lot of this has already been baked in. And so we're doing two things in our portfolios. One, in preparing for both of those things, we've been adding fixed income exposure. We feel confident that we're going to hit peak rates within this year and that we will see some of the cracks in the macroeconomic backdrop could give the Fed some pause. And so we've been adding quality fixed income exposure, municipal bonds, investment grade debt, treasuries. The other thing is actually monetizing some of this volatility to build positions at a discount where you're actually able to take in some yield and then buy into the market if we do see a continued pullback.
Yeah, that's an interesting way to go tactically, using the volatility that's kind of priced into the market to one's advantage. When you say going into quality fixed income, would that be, in theory, out of cash, or would you be kind of reallocating from equities, which are already down most likely from your weighting into bonds?
So what we're actually seeing within our investors' portfolios is a lot of people have been significantly overweight cash to the tune of about 30% of their investment assets. So with the conversation around cash, you always have to separate out the fact that you have operating cash, what you need for household expenses, and then you have cash as an investment in your portfolio. Cash as an investment, given the inflationary environment that we're in, we know what the outcome is going to be in terms of that deteriorating value. So we see value in actually taking out some of that cash, some of your cash balances, and then investing. Again, we're not going down in credit quality. We're sticking with some of the higher quality parts of the fixed income market. And depending upon what state you're living in, look at some of these taxable equivalent yields in munis. You're reaching levels of 7 to 8%, and we're comfortable adding that exposure there.
When you talk about quality in equities, and it certainly makes sense at this point in the cycle by a lot of lights, but often that takes you to things like the very large tech stocks that led the way up and still are kind of in retrenchment mode at this point. Is that someplace that would qualify in your book?
I think for long-term holders, absolutely. When you look at some of these names that have sold off 30, 35%, looking at the opportunity to build positions over time or use some of those monetization strategies of volatility that I just went through. But I think to have a really meaningful turnaround in tech, you're going to need a pretty strong pivot from the Fed or some signal that inflation is abating and that there is some type of pause. So we like parts of the market where, for example, healthcare, investing in longevity in terms of some of the quality positions, looking at, again, these large cap durable demand type companies. Even if you go back to the 1970s, these types of companies were able to double their share prices over that decade, even in spite of those inflationary pressures. So those are the parts of the market where we've been investing.